好的，我就反正给它开在这儿，我给它最小化，我也不打。
Assalamualaikum and hi, good afternoon. Today we're gonna have our FAB sharing session by Dr. Zul Hazwan, Introduction to Spatial Analysis. We will start in 2 minutes. We wait for a few students more and our colleague as well. We will start at 5 minutes. We will start in 2 minutes. I will pass the session to Dr. Zul shortly. Over to you, Zul.
Another 3 minutes, right, Nana?
2 minutes, 2 minutes.
Okay. Yeah.
All right. Okay, I pass the session to Dr. Zul.
Okay, right. Thank you, Ms. Fahana. Before we start our session, let us recite Al-Fatiha. Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alamin. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Sallallahu ala sayyidina Muhammad wa ala alihi wasallam. Assalamualaikum and good afternoon to everyone. Thank you for coming for this session. This is actually my second session to share you the some new technique in econometrics. Okay, in the previous session, I had shared you the new technique in econometrics to use spatial analysis, and I believe some of you have attended the workshop. So for today, another opportunity for me to share you the some technique in econometrics called letters in econometric field that quite new and very rare yet in the literature. So meaning to say that you have a bit more opportunity, to have some possibility to publish in a good journal if let's say you try to use this technique. But then actually it again back to the issue of the studies. Okay, not all of the studies can utilize this technique. Same goes to the other technique. So today I would like to share you the one of the technique in panel data analysis we call a spatial analysis. a bit introduction on the panel data analysis before we go to our business today. Okay, let us try to recall back the revolution of panel data analysis. Okay, as we all know that the nature of data, the nature of data set or panel data is a combination between cross-section data and the time series data. So with that, we have two types of data set that we need to concern, we need to understand, and we need to aware. First is a micro data set. The micro data set is in the nature of where we have n greater than t, right? So should be n greater than t, and then the other type of panel data set is the macro data set. So a macro data set should be we have t greater than n. So this is the first step. The first step and important step in order for you to go further to the next step. The next step is actually to choose the suitable technique for your study, right? So definitely the nature of the data set for micro and macro is quite different, and then the technique also very different. So each of the technique actually has its own advantage and disadvantage in order to treat the data, the sample of the study. Okay, now we go to the micro panels, micro panel data. If you use micro data and you have your n greater than t, then these are some of the techniques that you need to figure out and you need to utilize. Okay, we have pool OLS. This is more to homogeneous model, and then we do have random effect model, fixed effect model. These two, random effect and fixed effect, is more to heterogeneous model. And the last one, we have GMM. The GMM is more dynamic, and definitely GMM is one of the heterogeneous model. So using this if you use this four technique, actually this four technique have an advantage whereby these models have the advantage to treat the micro panel data set. Okay, so if let's say you have the t greater than n, or you have longer t, but then you have some few numbers of n, but you have longer t, then my opinion, my advice to you, please do not use this, because the disadvantages of this model is that the power for this model to do estimations, to deal with the data set whereby the data set have longer t, then it's very weak, because this model is not really have a good power, or not really efficient and effective to deal with longer t. Okay, after this I will show you what is the problem when we have the t. Okay, when we have the t is quite long, quite longer than the standard one, right? Okay, now we go to the macro panel data set. So the macro panel data set, if let's say our data is in the nature of n greater than t. So as I told you just now, if you use the first generation of panel estimation to use pool, random effect, fixed effect, and GMM, that estimation is actually have lack power to deal with the data set that have longer t. Okay, so what you can do, okay, another technique that you can use that used to be more suitable to deal with the data that have t that they have a longer t. Okay, the first model here, we have mean group GM. Okay, sorry, MG. Okay, MG got static and dynamic, and then we have CCEMG, got static and dynamic. We have MG, augmented mean group, static. We do not have dynamic for this technique yet. Okay, we have fully modified OLS. This one is quite common. And then we also have dynamic OLS. This is also quite common nowadays. You can find it in the reviews and then in the data. And then we do have the panel main group. It is it is a dynamic technique. And then we also have dynamic fixed effect model. And then the quite latest one, we have cross-section ARDL, that one dynamic. So as you can see here, in macro panel data approach, okay, the technique that deal with macro panel data set, we do not have a homogeneous. We do not have a homogeneous model. All of this is considered as heterogeneous. So in sum, what can I say? This model actually is very suitable, have a very, it's more powerful to estimate the data set that have longer T. Okay, do not confuse with that. So if last time we have a very, very limited technique to deal with panel data analysis, then we can use this. That still can acceptable. But nowadays, especially in economic field, so if let's say in micro panel data, if in finance and in accounting, then would be fine and still acceptable. But then for economic field, try to use this quite latest, and I'm talking about how powerful, how effective, and how efficient is that technique to deal with a situation of where we have longer T. Okay. Okay. Let us discuss a bit on the conflict in when we are utilizing panel data analysis. First, we deal with the problem heterogeneity. Okay, heterogeneity actually, if we normally it will happen if we use a short panel or micro panel. Okay, so the what do we call the remedy in order for us to overcome this problem, we can use heterogeneous model. Example, just now I mentioned, I list up the model that we can use to deal with micro data set. We have pool, OLS, we have random fixed effect, okay, and then GMM. So in this case, if let's say our estimation is not blue, then do not try to use pool OLS. So normally if let's say like if you are in finance or accounting field, it is very rare case that we can use pool OLS unless we use the primary data. So mostly in order for us to overcome the problem, we will use the random effect, fixed effects, or GMM. Okay, another problem that I want to address here is about the T. What will happen if let's say we have longer T? Autocorrelation. Okay, the autocorrelation normally, if let's say we use the macro data set, we have longer T. So in order for us to overcome that problem, we need to use dynamic. Okay, we need to use dynamic. But somehow, in recent technique in econometrics, got the static model in panel data analysis can deal with autocorrelation like CCEMG and CEMG and MG static. But then if let's say you have T like more than 30 or more than 35, then please do not use static. Please use dynamic, because if let's say you have T like somewhere around 40 years or 40 months, in terms of quarter, we have 40 quarter, then the static model is not that powerful, it's not that effective to treat the analysis to have that kind of T. Okay. So the third one, so this is quite recent development in panel data analysis. Okay, in economics, okay, we cannot run away to have the factor of what do we call autocorrelated or multicollinearity, because in economics we believe on interdependence due to the globalization factor. Then that one is quite common. Okay, that problem is quite common. But when we apply statistics, econometrics, then we need to concern about this in order for us to make sure that our estimation is robust. So even though in economics, theoretically we are fine with that, but then mathematically, statistically, or econometrically speaking, the multicollinearity or interdependence factor actually will lead to bias estimation. So up to now, then we have a new technique to deal with that. So we call it the factor of interdependence, right? The factor of interdependence and interdependence among the countries among the N, or autocorrelation among the T actually, right? So in economics nowadays we call it as the cross-sectional dependence. Okay, so nowadays we have the technique to relax the problem of cross-sectional dependence, so that we can improve our estimation more effective, more efficient, and more powerful. So nowadays we have the estimation, panel data estimation with cross-sectional dependent. Okay, and then the latest one, this is the thing that we want to discuss today: spatial analysis. Okay. Okay, maybe some of you are not very clear with the cross-sectional dependence. Okay, I will give you the example of cross-sectional dependence. The best example is the spillover. Okay, the spillover, or like a bilateral trade among our neighboring country, meaning to say that the numbers, example like the numbers, the value of import and export that we have actually derived from the other countries. So if we pull them together in one sample, then it will create, this is what do we call as the problem of cross-sectional dependence. Okay, exit in our panel data set. That is the problem that we want to take account. Okay, that's why we have the panel estimation with cross sections, and then the latest one we have spatial analysis. So I list down here the what do we call this? The advantage of each model. Okay, the advantage of each technique in panel data analysis. First example, if we use homogeneous model, pool oil as, then the advantage of this model is that we can overcome the problem of degree of freedom, due to we pull all data in one set, regardless we are not the same country, we are not the same country, the same race, we are not the same, we do not have the same characteristic, we are not in the same category, but then we put in one data set, one sample, then definitely we do not have a pressure on degree of freedom. This is one of the advantage of pool OLS. But then we need to question how reliable and how practical is the estimation in the real world. So if let's say the second one, if let's say we have heterogeneous model, okay, so definitely we can improve heterogeneity factor. So this one, like the example of this heterogeneous model, like random effect, fixed effect, we have types of mean group technique. Okay, another one we have the third one, a dynamic model. A dynamic model, as I told you just now, if let's say you have t greater than 35, it's better for you to use dynamic rather than you use the static. Okay, So static here mean I'm talking about the third generation of panel data analysis. You can use mean group CCEMG and AMG. Okay, but then if you have the dynamic, if you have the T greater than 35, your panel data, please use dynamic. So how about if let's say your sample, right, your T is around 30 or like 29 to 35. My own view is that you can use both model and both dynamic and static. So if you can use both model dynamic and static, the advantage is that you can capture the estimation at panel level, and also you can capture the estimation at country level. So you can make you can come up with the comparison. What will happen if we merge all countries in one estimation, and we can see the variety of the result at country level. But somehow we can conclude that if let's say at panel estimation, our estimation is robust enough, good in fit enough, we can conclude that each sample countries actually is heading to the panel estimation. But then in current situation, we can see how the country's specific estimation react in their way to reach to what do we call that, panel estimation. Okay, the third one, panel data estimation with cross-sectional dependence, as I told you. So in economics, we cannot run away from the problem of interdependence and then the spillover effect, right? So nowadays we have the technique to relax the cross-sectional dependence. Okay, we can what do we call, improve our estimation to relax the problem of cross-sectional dependence using types of technique. But then this type of technique actually, the weaknesses of this technique actually, it is not capturing the power of spillover effect. Somehow, in reality, or as a policymaker, the spillover information is very important. Okay, we cannot ignore it in our model, in our estimation. So that's why we have nowadays panel data analysis. That's why nowadays we have spatial analysis. Spatial analysis here actually, it can capture, this model actually can capture the magnitude impact of spillover effect. Example, like we know that we have a good bilateral relationship with Singapore due to geographical factor, right? But then but then we want to know the strength of Singapore economy to help to push or to influence our economic development. Then the spatial analysis can help us to capture how strong is how strong is the Singapore economy to help us to move further. This is what we call as a spillover effect. Okay. Right now, now we move to the our business today, the spatial analysis. As I told you, so maybe you are aware with the example, like the model that the panel estimation with cross-section dependence, like CCMG, or the latest one is the CSARAL, right? That one actually they're concerned about the existence of the spillover effect or interdependent factor, but then they move it to like error term example, so that we can meaning to say that if you use that model, that technique actually already eliminate the factor or to relax that kind of factor. That's why we can capture the magnitude. So if you use spatial, actually, so spatial actually can retrieve the impact of spillover effect. Either we put it, either the technique want to put it in error term, we still can capture it. If let's say, like, if you refer back to the technique in fixed effect, right? They put the way they eliminate the problem of spillover effect. They put in the model, but then it's equal to 0. So, but then here the spatial analysis, regardless we put it in error term or in our model, we still can capture it. Example, like we do have in panel data in spatial analysis, we have 3 types of model. First, spatial error model. So the spatial error model here, after this I will show you the, what do we call that, the model, the technique, the model, or the regression in spatial error model, whereby we can see very clear that if we use spatial error model, they put the spillover effect in at the, what do we call that, error term side. So secondly, we have another model called as a spatial lag model. Then this model actually try to capture the spillover effect happen in the dependent variable. Okay, the last one, we have spatial Durbin model. This technique is actually assume the spillover effect actually exists in the dependent variable. Okay. Okay, right. Now we go to not to say too details. If theoretically, I think we need time to discuss how it works. But then in general, maybe you can do your own homework after this. Okay, in general, spatial error model, as I told you just now, right? If you can see, this is the regression, the model for spatial error model. So the W here refers to the factor of spillover. Moment, let me check. Okay, I forgot to mention you about this. Okay, spatial analysis model is to capture the spillover effect or negative externalities. So in the end, later, we can see the value of the coefficient. If let's say the coefficient is positive, meaning to say that that is a spillover effect. So if let's say it's negative, that one is considered as negative externality. That is how it works. Okay, now in this case, actually, we can see clearly, if we believe on the spatial error model, right? So we believe that the spillover exists in our model, but then we park it, the value, we park the factor of spatial, the factor of spillover effect or externalities factor in error term. Here in error term. That's why spatial error model here, the error term is a combination of the origin error term, and then we have W. W stand for the factor of spillover effect or externality. So if we regress, if we utilize this model, definitely we can get the value of this. But then when we consider the spatial effect exist, but in the error term, meaning to say that it is not, how can I say, it can be a temporary impact to our economy, to our business, but then in other words, it's so-called as not an important factor for us to concern, for us to consider in our estimation. That's why we put it in the error term. Okay, so after this we will discuss how can we know which model is suitable, right? Second, spatial lag model. Okay, the spatial lag model here believe on this. Okay, the spatial lag said the dependent variable, the spillover effect just happen in a series of dependent variable. So that's why if you look here, right, W instead of in error term, W is exited here. Why? This one is lag. Okay, example, in other words, in a simple word, okay, example, right? This is our countries. Why our countries? So this is the y, the factor of y from our neighboring countries, our partner. Okay, y of our partner to influence our own y, but in terms of lag. This is what it means, partial lag. So this model believe that the spillover effect or the externality factors only happen in a series of y. Okay, and the third one. So the spatial Durbin model suggests that the factor of externalities, including this the spillover effect, happen in independent variable, like this W here. Example in a simple word, right? So this is our own independent variable factors in our own country. This is factors in our partner countries. So from this, if we use this model, actually we can capture the coefficient from our partner, how our partner can influence our subject. This is our subject Y. Instead of our own factor, our internal factor, we can capture the external factor derived from our partner. This is what it means. So meaning to say that we have three models, a comprehensive. These three models is try to give you a comprehensive information about the externality factor. Either it is a temporary effect, or it is a permanent effect, but in a channel of dependent variable, or it is a permanent impact through that will affect our country through independent variable. This is theoretically what is spatial trying to do. Spatial analysis is trying to do. Okay. So since we are not a mathematician, statistician, so we really rely on the development in the software, right? In software, right? We do have a lot of software, okay? And then today I will share you how Stata can help us to make our life easy as an economics. We are not really expert on in mathematics, in statistics, but what we can do, how can we apply it in our field? We can use the available software that can treat the spatial analysis. So, how can I say? So, meaning to say that if we are not a mathematician, if we are not a statistician, we rely on the development of a big data of science, right? So the software, IT software, in order for us, in order to help us, instead of we are doing it manually, okay, to calculate the coefficient manually. Nowadays we have the data, so we really depend on the development, especially example like here in Stata. So in the Stata, if you refer to the Stata, we have multiple commands. Okay, we have multiple commands that we can use for spatial data analysis. Okay, this is my personal view on spatial analysis when we use data. Okay, what can I say? We have a lot of command in Stata, but then for me, the command here sometimes not stable. Not stable in terms of not to say that it is not effective, it is not efficient yet. It's still no, it's not that in that way. It still can be used. It's okay and it's effective and it's efficient. But then not stable in terms of what we have a lot of command. So this command actually can be used. Okay, perfectly can deal with some certain data set. This is what I mean. Not stable. Not stable. Not in terms of the result is changing over time. No, the result is still the same. consistent. But then in terms of the command itself, each command actually can treat a very limited nature of data. This is what it means. Okay, example like this, we have 4 types of command. Okay, the first command is SP regress for spatial regression, spatial effect regression, and so on. So this command treat a cross-section data only. So if you can see here, geofile. Geofiles means geographical characteristic file. So geographical characteristic file, if we put it in IT language or software language, we have a lot of type of file to give us an information. Meaning to say that we need a file to let Stata knows the information of geographical characteristic. So we have shape. Shape is one of, you later can Google what does it mean by shapefile. Shapefile is one of it's like a map. But then a map here, it's not a map in words. It's not a map in picture that normally we can illustrate easily. But then in this case actually shape has the information for geographical characteristic. Okay, so if you use this command, then you need to use shapefile. So the command actually can deal with this, can give us an output of the 3 model that I mentioned to you just now: spatial error model, spatial lag model. Okay, and then we have spatial Durbin model. So we have another version of command, SPXT regress. So this one for panel data set. So definitely they use shape. Okay, what is the issues here? So if you use this command, the problem here, we need to link the shape file to Stata. So if you use this one, you cannot use a country sample. You just can use a stat sample. But then a stat sample is very limited. So as far as I'm concerned, when I check back the nature, the information in the Stata, and then even though in the Stata journal, what I understand is that if you use this command, you just can deal with the data set in stat level. In the stat level, just only in Europe or some other area in in US and some other area in Europe. Due to what? So in order for you to link shape to Stata, they need 2 geographical code. The 2 geographical code here just only exist in US and some area in Europe. So that's the thing. That is what I mean. If let's say we want to use Stata, if you use this command, if you want to, let's say you want to come up with a study in ASEAN in ASEAN region, so definitely it cannot be done, because in ASEAN we just have only 1 code in shape. But then this command need the shape file need 2 geographical code in order for us to link it to Stata. So in this case, what can I say? Forget about it. Okay, forget about this. So we cannot do it if let's say we want to do the study in the country level. Okay, so never mind. We have another version that we still can use. If let's say you are interested to study further on spatial analysis. Okay, we have XSMLE. Okay, this is the command that I think for me quite how can I say, quite universal, so called. Okay, quite universal, quite friendly user. not so friendly user, but quite friendly user. But then we need to have, instead of shape, we need to have gull. Gull is another type of geographical characteristic part. Okay, gull. I will show you some technique. So gull is actually derived from shapefile. So now, if let's say we want to use this command, we need to convert shape to gull. So from gull, then we can put simply transfer the information of geographical characteristics in data. After this, I will explain you what does it mean by geographical characteristic. I have a quick question here. I will answer these questions later when we have some short break. Is it okay? Roland and then Murtaza. Okay. Okay. Right now. So the last one, much simpler than XSMLE, much simpler command, whereby no need for us to use shapefile, no need for us to use gal file. We can use our own file in Excel. But then, unfortunately, this command just only can help us to generate the result from spatial lag model and spatial Durbin. So we cannot retrieve, or we cannot analyze the model based on the assumption proposed by this model, spatial error model. It's fine. If you can see the difference among these three models, definitely we are interested on SDM, spatial Durbin, because the spatial Durbin will give us more information, right? But then when you come up with the paper, when you come up with the manuscript letter, definitely the reviewer will ask you, how about if, let's say, the spillover effect just only happened temporarily? So you need to use SEM. So, but then if you submit to the journal, a good journal lah. So it's the journal that quite simple and not really concerned about the model and methodology, then I don't think so they will ask you that kind of question. But then for our own satisfaction, we need to know, we need to really know the, what do we call it? The information for better understanding. All right. Can I, not to say a break, can I answer the two question before I proceed to the analysis? Sorry. Where's the question just now? Moment. Blur pula. Okay. Murtas. Check back. Okay, Murtaza, can we go with dynamic estimation with 25 years? How can I say? If you use 25 years, if your T have 25 years, and then you have your independent variable like more than 4 or 5, then your estimation is quite weak due to the problem of degree of freedom. So bear in mind, if you use dynamic, it is the dynamic panel data set is not to pull all n and all n and t together. If you use dynamic, the dynamic estimation procedure will look at how much t you have. Okay, that is your observation. So in statistics, in order for us to make a decision whether it is reject or not to reject, we need to refer to the degree of freedom. So let's say you have 25, okay, 25 years, and then you have another, you have your, let's say your independent variable is 5, minus 5, 20. So 20 is not that robust enough. But in panel data, the difference between panel data and the time series or cross-section data, if let's say your degree of freedom is 30, I'm talking about degree of freedom, not your sample. Your degree of freedom is 30 after you minus your, what do you call it? After you minus your independent variable, 30, then still fine. But then in panel data analysis, make sure your degree of freedom minimum 25. So meaning to say that you will have the figure of 25 after you minus your independent variable. So it's still you try and error. So based on my experience up to now, I can go for degree of freedom not 25 but 27 and 28. Then I can get a good result. I mean a robust result. The model is good in bit. Even though in Stata or even in the time series, you can get the result, but then you can find that your estimation is not in good fit. Okay, so very cool, Roland. Is there any other web software that can perform spatial? Yes, we have a lot. We have a lot. GIS, one of that. Even though Geoda also can use that, but then quite complicated, and not all model can be used by Geoda. If I'm not mistaken, R also can use that, but it's uh, quite complicated, not very user. Same goes to the MATLAB. But then the most easiest one is Theta. Okay, okay. Okay, let us proceed to, got no question, right? Stop sharing, I will share it again. Hilang pula the slide. Yeah, I'm so sorry. For today, I cannot what do you call it? I cannot do the hands-on activity due to the limitation. It's quite difficult actually. If you use that, if you use spatial analysis, if you want to do analysis on spatial analysis, quite difficult. It is not just only the visual is not from Stata. The visual is we need to have a multiple visual. So it's it is not that productive to do virtually. Okay, before I proceed with that, I want to share you something. I stop sharing. I share you my data. Okay. Okay. You can do your on what do we call it? You can, sorry, what's happening? Okay. You can do your own homework to know in details the what do we call it? To know in details the content of each command. Example like this, help request. Okay, you can see this. Okay, the name of this model. Okay, the command, right? So under this, what do we call it? Under this model, we have a type of models, a variation of model that you can use. You can try and error which one can give you a good result. So here at the bottom, we'll give you example, if I'm not mistaken. Example to read like this one. Okay, example. Okay, this is the variation. The 1, 2, 3, 4. We have 4 types of variation that you can try. Okay, another one, you can try this one, as I told you, but then forget about this because we actually do not want to concern a case happen in US and some countries in Europe. If I'm not mistaken, Portugal have 2 court can use it, but then it is not our business. So our business here is that, like example, XSMLE. Am I too fast? Okay, so far so good. So this one. So this we have 1, 2, 3, 4, 5. Okay, we have five command in this. If let's say we want to use this command, then after this I will show you why we need to why we have a lot of command, why we have a lot of variation. After this I will show you why. Due to, as I told you, the problem of the nowadays the software is not that it's not that, what do we call it, not that stable. We need to use another command to figure out which command is suitable with our data set. Okay. Murtaza, as I told you, the proxy for spatial effect is W theoretically, but then I will show you the output to show the impact, to show which is the coefficient belong to spatial. Okay, so these are the things. Okay, you can do your own data. You use Spata and then try to have further understanding on that. Example like this, you see, I think in the last bottom, this is the example of the command. Okay, but then never mind, I will show you things that we are using today. Okay, the last one is this, as I told you for this one. Okay, if you look at this, it's clearly mentioned here. It's clearly mentioned here. See, model option, yes, only spatial lag and then spatial Durbin model can use this command. Spatial error cannot. So we need to use the other command. So this is one of the things. So we need to use multiple command, and sometimes in econometrics we need to use even 2 to 3 different software in order for us to get a good result. Okay. So, okay, for this, I stop sharing, get back to the slide. Where is the slide? Yeah, I mean, all right. So now, when we want to do the spatial analysis, we need to pair. This is the most important part in spatial analysis. Recall back to the procedure. If we want to use the, what do we call it? If you want to do the dynamic panel data, right? The dynamic panel data, then the first step you need to do is cross-section dependent test to see whether there is a problem of externality or not. Then the next step, we need to check the unit root nature. Okay, then the unit root nature is very important. We want to know the nature of the data, whether got unit root at level or at first. Okay, same goes to the spatial analysis. For spatial analysis, we need to have metrics. We need to come up with metrics. What does it mean by metrics here? We need to pair. So we need to pair a country with her neighboring country. Example like here, right? Example, let's say our country is A, then we know that A and D is our neighbor country, and DCB is our neighboring country. So we need to pair it. You see this one, in the box one, A0 definitely our own, right? So BCD 111, right? 111 here, our neighboring countries. E0. My question to you now, can E influence A? That's the question in our mind, right? Can E influence A? Can. Because we are not only connected. A and D, A and C, A and B here is not only connected via cross-border, right? Nowadays we have we can be connected via sea, via land, and also by air. And even though nowadays we have internet, right? In digital economy, we still can be connected. Okay, now, but then how it move? How physically it move? E will go to D first, and then D got the impact, and then from this impact, D give to A. So that's the process and so on. That's why in spatial analysis, we need to come up with the metric to let us know, even though A and E geographically got no element of cross-border effect, but then the cross-border effect can be happen through the relationship between D and C, or C and E, B and E. That is how. So basically, so that's why we need to have metrics. And then again, it is impossible for me to explain in detail in this session. Oh, 1 jam lagi. In this session, how it works. So you can do your own homework, or maybe if we have opportunity later, we have the session longer than this, then that I have the then I can have the opportunity to explain to you in detail how it works. So now, how we can do this? How we can create a matrix, not manually, but using the program in Stata. This is the command. We have two types of command. Again, why we need a lot of command? So like this. Okay, if let's we can create spatial metric in Stata to know who is our neighbor, right? Geographically, right? Okay, we can use SPMAT. Bear in mind, if you use this command XSMLE, then we need to use this command. So if you use this command, then you need to use this spatial metric command. So this is what I mean. The weaknesses to use the current what do we call it? The current software actually is not comprehensive. So what can I conclude here? Spatial analysis is still new, and we still need more development, more software. We still need software engineer to help us to create another command that is more friendly user. Okay, this is what it means. So now, for now, the objective is that to let you know, you need to use two types of command, and it depends on the command that you use. Okay, so this is some ideas, the basic ideas in order for us to create a matrix. So meaning to say that we need to create a matrix first, then we can put that matrix in our model. Okay. All right. Let us go to some practical discussion. Okay. Basically, this is one of the material that the material from my consultancy project with NUPI, an international institution in Norway. So I just use 0.001% data from that project. Okay, and then that project use big data. Sorry, not 0.1% only. And then I use it to explain to you a little bit basically how it works. Okay, how practically we can do a spatial analysis by using Stata. Okay, this is the model that I propose. We have GDP, gross domestic product, a function of globalization index, refer to Shabazz paper. Shabazz paper introduce globalization index, and then in this model I also use the corruption index. So in this case, I want to capture the behavior. I want to have some understanding, some good understanding behavior on how globalization index and corruption index influence a change in GDP. In what? After this, I will show you the countries. So the data set is from 2010 or to 2021. Okay. So, okay, this is the countries, geographical characteristics. So we believe in this. Okay, if we are really in economic, right? We we have a fact. We believe on interdependence. Okay, we are interdependent. So this is the example of the countries. I use ASEAN countries. First, due to geographical characteristic, we how can I say, we are neighboring countries. Okay, and most of the countries we have a cross-border effect. Okay, like Malaysia, we have a cross-border effect from China, from Indonesia, Thailand, Philippines, Brunei, and so on, right? And same goes to the other countries. In the end of the day, if we put it all in one session, in one sample, right, we find that used to be we are integrated. But then the question here we need to answer the strength of neighboring countries to affect our performance, our economic performance, right? We have 11 countries here. Okay, what is this latitude and longitude? This is the geographical characteristic. You can get it the data in Google. Okay, we need to have this. We need to have this. Okay, because we want to know we want to inform this data about the geographical characteristic, so that we can notify which country is our neighboring countries, which country is not our neighboring countries. Okay. Okay. Now, as I told you, now we need to have gal file. Okay. Forget about SHAP. That command cannot be used and cannot be used in Malaysia, in ASEAN, due to, as I told you, we need to have two chord instead of lat and lon. We need to have another two chords. That was what I mean last time in the previous slide. So forget about that. So we need to convert. We need to convert our geographical characteristic here in shape file. This is what I mean. Okay, CSV is the Excel file. Okay, to shape. We need to convert to shape. Then we have this. This is what I mean. When you put your data, this data, right? Definitely, shape file will be created like this, huh? Like this. Shape file will be created here, so they can detect the information is given in the software is ASEAN here, right? Definitely, it can be captured here. Then we will have shape file. Okay. Now we have shape file already, right? We want to we want to convert our shape file to gal file. Okay, to gal file. Yes, definitely for spatial analysis, a lot of steps. Okay, I don't believe that you can simply get use with this just only 2 hours to listen to my sharing. You need to use your own homework, and I welcome you if, let's say, you need some further guidance or opinion from me. You can contact me through email. Okay, and then as I told you, when you convert to shape, definitely we got the map. See this. Okay, when we have shape file is one of the geographical characteristic file, and then we need to convert to gal file. Why we need to convert to gal file, as I mentioned to you just now. So the command in Stata just one gal file. Okay, we need to use Geoda. So this is the first software we need to use. Okay, you can go to this link for software, and then in order for us to create a gal file, you need Geoda, Geoda. Okay, I put in the in the chat. Geoda, Geoda software. Okay, so the Geoda software here, this is the step to convert from shapefile to Geoda. Okay, and then you have, in the end, you will have gal file. Okay, now you have gal file in your laptop. You need to put your gal file in Excel. In this data. Okay, so this is what I mean. Okay, this is the location of your. That's why I said it's quite difficult for me to conduct the spatial analysis virtually, because we need to have multiple what do we call it, multiple screen. Okay, multiple file, multiple location. Okay, this CD stand for the location of the file. You need to put shape file, you need to put GAR file, you need to put your Excel data set, that Excel data in one folder, and then this is the address of your folder in your desktop. And then basically, okay, this is the first step in Stata. This is the command for us to inform the data, the nature of our data set. So definitely now, once you key in the model, the command, then Stata will understand your data in a balanced data set, and then the year from 2010 to 2021, and this. So now, as I told you, now we need to do metrics. Okay, once you link your shape file, or once you link your GAL file, okay, your geographical characteristic file in data like this. This is the command spw matrix import, using this name of GAL file. In the end of the name of this file got GAL file. This is the geographical characteristic file. Okay, and then this is the command, and then this is the name of your metric. You can put whatever name you want. Okay, you need to put this one so that the data knows that you want to do panel. Okay, if you do not put this one, rows 10 TXTW in the bracket years, then the data will assume that your data is more to cross section. So you need to put this because you want to do the panel. Okay, panel. See the GAR file matrix successfully, right? So I have my own matrix here. The name of my matrix is W, is contig. Okay, so that's the first matrix. All right. So if we call back to cross-sectional dependence test, right? We have a lot of tests. So same goes to this. We have Moran test. Moran test is to identify or to capture statistically whether the spillover effect or externality effect existed or not in our model. So we need to use this test. If let's say the model suggests what do we call it? Our model has the element of externalities, then we need to use, then we can proceed with spatial analysis. If not, then we do not have any purpose in the end to do the spatial analysis. But if you ask me in economics, externalities factor will be exited. We cannot run away from the issues or from the factor of interdependence. Even in fact, nowadays we are dealing with the globalization, we are dealing with the digital economy, then we are much more integrated. So definitely it will be exited in our model. So this is the command. So as you can see here, right? So it significant, meaning to say that my model just now has the externality factor that I need to concern, that I cannot just simply simply what do you call, ignore it. Murtaza, where we have to put GAR file, so that's okay. Once you have the GAR file, you need to gather your data, your GAR file, your shape file, your panel data, your sample in one folder in your desktop. That's why I thought. That's why I mentioned to you just now. I get back to this. Sorry. This. So once you created your folder in your desktop, you need to put it here. Okay, CD here. So this is actually the information that you want to let Theta know. You want to link the file in this location. Okay, right? Definitely, the Moran test suggests. I advise you further to. I have advised you to Google to explore further the Moran test. The Moran test is to detect whether the cross-section dependence or else the externality factor is existed in the model or not. So it is significant, then there is. Okay. So another command for us to create the metric just now, we can use smpat. This is the command smpat import w is the name of the matrix. So I just want to differentiate w underscore config and w to differentiate. This is to use this command. This one is using smpat command. So that is the thing. Not really an issue, just only the name. Because some of the regression, some of the command need to use this matrix, and then some of the command can just only work to use this metric. Okay, once you convert it, you see in the end geoda replace. So what does it mean? So we want to import. Okay, the stata, we want to import the geographical information in the stata. So we have this. Okay, you have this. Okay, then this is the character. So once you have this kind of details, meaning to say that stata already understand your geographical characteristic information. Okay, this is the detail from the stata. Okay, total 44, and then mean here at least 2 countries are neighboring. Okay, so it cannot be done. The minimum number here cannot be 0. Okay, so if it can be, if it's 0, you need to think about to add on or to remove some countries. All right, now we go to the estimation. So got one question just now to ask. For 45 minutes. Okay, to ask about how can we capture that one. Okay, now we go to the estimation. Okay, the estimation here. We want now we try to estimate spatial error model. The spatial error model, as I told you just now, the externality factor just only exist in error term. This is lambda. Okay, the main here, this one, right? Main coefficient here, right? This is the coefficient that we are aware. We understand, and then the normal, the standard coefficient that we use. Okay, we use in the estimation, in the standard model, in standard technique. But then for spatial, we have this. So here you can see, right? You can see it's significant. Okay, the coefficient for spatial in error term significant 0.156, meaning to say that it is a spillover effect. Why? Positive value. The coefficient is in the positive value, but unfortunately, the spatial effect here, we cannot recognize, we cannot identify the spatial effect here through what channel, dependent variable or independent variable, but it is just only happen in error term. So it is just a temporary effect, but we do not know what channel it affects us. This is one of the weaknesses of this technique. So we have this one on my left side, right? On my left side, random effect. My right side, fixed effect. So why we can have random effect and fixed effects due to random effect and fixed effects. I mean, like technically, we can we can disaggregate the error term due to these two model is very, very standard in calculating or in measuring the standard error. So that's why it's much easier for us to break down which one is the standard error term and which one is the error term due to spatial, due to spillover effect. In this case, spillover effect. So again, if we compare fixed effect and random effect, the coefficient for spatial, okay, in error term, not much vary. Significant and not much vary. So it's consistent, not an issue, right? Okay. Okay, now we go to the spatial lag. Okay, the difference between this and this, right? The spatial lag, the idea of the spatial lag to say that the spatial effect exists via dependent variable. As I told you just now, the dependent variable. So we can get this is the magnitude rho. Okay, positive. So meaning to say that this estimation try to tell us that the GDP of our neighboring countries affect our own GDP by how much? 0.1917% positive spillover effect. So meaning to say, if like us Malaysia, right? If let's say Singapore, the GDP of Singapore increase by some percent, definitely it will push our GDP up. This is what it means. So same goes to the Indonesia, right? Our labor market is quite very much rely on Indonesian worker, right? To support our primary sector, definitely. So for whatever happen in Indonesia, either good or bad, it will affect us. By how much? This is the magnitude is trying to tell you this. But in this case, this model try to tell us that if let's say the GDP in Singapore, GDP in Indonesia, GDP in Thailand, GDP in Philippines, and how about Myanmar? And how about the countries like Vietnam? It's far away from us. We do not have the factor of cross section, of cross border effect. It still can even though Vietnam also still can influence us, even though geographically we do not have the cross border effect. Maybe Vietnam deal with our neighboring countries. So from that, our neighboring country will deliver what happened in Vietnam to us. Supply chain effect, something like that. You know that. Any questions so far? Tak ada. Alright, I proceed. Okay, this one, got question. Tanyalah soalan pening kepala. Is it the average of our neighboring? How can I say? Is it not to say average? It is not an average. You need to recall back. If you refer to the AMG, right, augmented mean group, try to go to the paper. I forgot the name of the mathematician who introduced the AMG. It mentioned that it derived from individual effect. Then they pull, not average. So there is it's like the way, for my understanding, it's like the way of do you remember when we want to compute the coefficient, okay, manually, right? That is the step. It is not an average. It is the econometric technique or statistical technique to capture, to measure, or what do you call it? To compute the coefficient for spatial. It is not to say that it is average. Not a good way. Do you want to share the letter? Please contact me. Kelvin. Okay. Please contact me later. Okay. All right. So that is. So now we go to this. the last model, right? Spatial Durbin. The spatial Durbin, this is the technique. Okay, spatial Durbin. So this is the command. Spatial Durbin. If you can see here, WX, right? The WX here, dependent variable. WX here is the spatial coefficient, or else the externality coefficient. So if you look here, both significant. Globalization index of our neighboring country will push up our GDP, spillover effect. But if you look here, this model suggests that corruption index, an increase of corruption index in our neighboring country will give a negative externality to us. It's quite not so makes sense. Maybe there is some channel, but the estimation try to tell us, if let's say, example like Indonesia improve their corruption index, we will negatively affected from that action. I do not know how. Maybe if let's say they improve their corruption index, we have a shortage on our labor market due to their people, their worker do not want to work with us. They want to stick with their countries, maybe in that way. So this actually model try to tell us that this spillover effect or the negative externalities effect will affect us through what channel? Through dependent variable. Okay, so got any other question? Since our dependent variable has many countries, how we can know which countries? Yes. So that is why I was telling you just now, refer to the AMG journal, the paper introduced AMG, augmented mean group. From that you will know how the coefficient can be calculated. Definitely not from average. And same goes to this case. The dependent variable from which country and which country is same thing. The coefficient is not on average, but then the calculation, it's the procedure still still using a standard econometric and statistic step and technique to calculate the coefficient. You need to refer to that. So if you are not very sure, you try to email me, and then I will give you the name of the paper, because I forgot the name of the paper. And actually I am not expecting this question will be out today, so that's why I'm not preparing the material. But then I can share you. Then when you can email me, I will give you the paper. Then you try to understand the step. Okay, it's out of it is actually out of the topic. That one is more to econometrics and statistics. Okay, thank you for this tough question. All right, so I come up with a summary here. Berapa minit lagi tinggal? Nana dah balik awal ke? Kejap kejap lah.
After the 35 minutes, relax.
Pening pala je lah. Sikit je. Okay, now in summary. So as I told you, from Stata, I have registered 3 models: spatial error model, spatial lag model, spatial Durbin model, right? So this is the model. Okay, again, we recall back spatial error model. I put it here. This is what is this? Lambda. Okay. Pening. So lambda, right? So the lambda is a part of error term. We can capture it, but unfortunately, we do not know from what channel it affects us. So it can be a temporary or just a noise, a noise fan one. We do not want to bother. Okay. Next, we try to use spatial lag model. Okay, we just want to test either the spatial effect, or the externality effect, or apa benda ni? Lupa. Astagfirullahaladzim. spillover effect. Sorry, the spillover effect through GDP, right? Positive. Spillover is positive. Okay, and then the last one we used quite complex model that try to identify or determine the spillover effect is this. This one this one should be negative. Okay, I'm sorry. This one should be negative. We find that globalization has a spillover effect and corruption index, a negative externality index, and negative externalities giving a negative externalities effect. So sorry, this one is negative, not positive. Okay, now maybe in your mind, statistically, which one better? All right. So we cannot simply put it all in our manuscript when we want to submit to the journal. Definitely, the review will ask. So which one is better statistically? Definitely, we cannot come up. We can confirm in reality. Quite difficult, right? So ada benda yang kacau. Alright, right. So that is the technique. Again, now I want to share you the limitation that we are facing since we are not a mathematician, statistician. Even though our econometrics knowledge is not that high, right? We just want to apply it, right? So this one, I did try various command. Then this data given me this. What does it mean? So for those who attended my workshop last time, the textual analysis, I share you one of the reason. So I try the data that in absolute data, absolute value, and then I try the data when I convert in natural log. So it's giving us a different information or a different estimation due to what? So in econometrics, instead of we are considering about the root test, instead of we are considering about multicollinearity, instead of we are considering about the what is that autocorrelation, the basic thing that we need to know the nature of our data. If let's say econometrics is all about to have a to ensure that everything is consistent, because we want to make a prediction, okay, estimation prediction, everything must be consistent. So that's why I said, if let's say all are consistent, then why do we need to convert to log? Convert to natural log, right? When we convert to natural, due to what? We do have like how can I say? The value of the model, the scale is different among the variable, then fine. So how about if the scale is quite the same, 100 million value, then how it goes? Okay, that's the first. So meaning to say, we cannot simply, okay, based on this paper published in that journal, then we convert to natural log. Cannot. There must have a valid reason behind your action. Okay, and then the second one. So initial values not visible. What does it mean? Do you remember? I told you just now the metrics. When we put the metrics in our model, then this is one of the limitations that software cannot deal with that due to what? Too many information. We have the standard information one, the data set, and we have another one now, the metrics. The metric is very complicated. Like in Malaysia, our navigation is this. Singapore, our neighboring is that. Myanmar, their neighboring country is different. So when we put them all together in the model, then what can I say? Software jam, cannot work well. This is what I mean. So that's why we have this. This is one of the limitations. So after this, I will conclude you what way we can do a test to choose which one is the superior model. So this is one of the limitation. Okay. I hope you can get what I mean. Okay. Okay, this is what I mean. So still we cannot determine yet which model is suitable statistically. Okay, statistically. Okay, now we put aside that matter first. Then the conclusion later, I will conclude how we can solve that problem. Okay, and then what else? Waduh, pening juga lah benda ni. Okay, now I tell you. Okay, I recall back lah. I go back to the earlier slide. Okay, just now, I propose this three to use this command. Then we need to have Sherpa. Then we need to have Galpa. From that, then we can use this command. From this command, we can look nook and cranny the spatial effect from where. Then we have three types of model. Am I right? So now we try this. So why we need to try this? Due to height. Okay, right. Sometimes there are many reasons. We want to study the spillover effect based on geographical characteristic. Sometimes we need to admit that geographical characteristic is not everything in economics, because due to what we call as like example, globalization, the revolution in transportation. What else? Another one is the digital economy, right? So the spillover effect is not just only affect us through cross-border effect. Example, right? If you watch a movie or a series in Singapore, a series in Japan, in Korea. So the behavior, the culture through that movies actually influence the pattern for us to consume the good in Malaysia. It is not physically, right? We need to concern about that. So geographically, it is not 100% support the what they call to drive the spillover effect from our country. There are other factors. So now we try this. Why? Why I said that? Due to what? So we can create our own file. No need for us to depend the information from GAR file. No need for us to have the shared file. No need. So we can create our own information, and then now we want data understand what does it mean by the characteristic that we want. Okay, example like okay, now we go to okay. All right. Okay. Now, this is what I mean. Create our own metrics. So in this case, I still use the geographical technique, geographical characteristic like what is it? Nampak ke? I nak besarkan lagi ke? Nak besarkan lagi ke? Tak, macam mana nak besarkan ni? Ni kot. Okay. Right? So I still use this characteristic. This one I put the information, this information in the data directly without from GAR, without from Sherpa. No. So if you want to consider after this, in the end, I will discuss you what else we can consider instead of LUT and LON. So you can put it here. You simply can put the characteristic that you concern. It can be a part of channel to drive spillover effect. Then fine. Okay. So I put it here. So now this is the way, the way or the procedure for you to create your own matrix. Macam mana ni? Okay, right? So once you put in the data in Excel, very simple. It's in Excel. So you can use this. You can use this what is it? Command. Okay, I put this one. So definitely non-geographical, we will talk about that later. So this one. So this command will this command will let the, what do you call it, Stata understand the geographical characteristic that we concern. We put it here. So as I told you, minimum here, minimum, right? Once you put the command and enter, definitely if it appear like this, meaning to say that Stata understand, okay, this is the metric that we are trying to tell to start Stata. Okay, and then we create the metrics from our own characteristic, and then minimum is minimum like Malaysia. Okay, how many neighbor that we have in ASEAN. So meaning to say that in this data trying to tell us each country at least has six neighboring countries. So in spatial analysis, minimum at least one. So if let's say 0 cannot be done, either you add the countries or either you remove the countries. Okay, this is the technique. This is just a technical thing in reporting, not reporting, in forming the data that suitable with Stata. Okay, all right, and then we have this. Okay, now in previous slide we cannot see how the nature of metrics, right? Do you remember the first slide? Macam mana nak buat dia jadi? Okay. Okay, in previous slide, this one, right? You see this box, A, B, C, D, E, A, B, C, D, E, right? This is a matrix. So just now I didn't show you because Stata cannot retrieve that. But using this command, right? Using this command, actually the Stata can give you information how the matrix is look like. You see this one? V1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 11, right? So 0, not a couple. 0, not a couple. So the other one is a couple. So the figure here, the value here in terms of the LAN and LON. How long, the value of the distance and so on. This is what it means. So we have our own matrix now. So now again we create our own matrix to put this. This is the matrix. This is the command for matrix, and then we have this. Nampak tak? All right. So this is the Moran I, Moran test just now. As I told you just now. So you need to look here. Partial error, Moran I. Significant, meaning to say that our model has externalities factor or spillover factor that we need to concern in what do we call it, in estimating our model. If not, the model is not what do we call it, it's not that robust, not in a good fit. So meaning to say that we cannot simply avoid the factor of spatial and the factor of externalities. Okay, and then as I told you, one of the weaknesses to use this command is that we just can have only 2 models. But then at a bright side, the model that cannot be catered by this command is not important, because that model, spatial error model, just concern the existence of externality as what do we call it, error term. So now not an error term. So we can see here SAR, right? Spatial lag model. So the spillover can be happen through the channel of dependent, right? You can see here, this is the command. Okay, I've highlighted here. So WL1, this is stand for dependent variable. My dependent variable is GDP, so it's positive. Okay, consistent with the previous one. but then definitely the coefficient is different. Okay, 0.8948. What does it mean? So the GDP from our neighboring country will affect us positively by how much? 0.8948%. Why percent? I log it. Okay. Okay, right, this one. So the other one, now we try to look at deep independent variables, right? Is it? Right. Okay, right. This is the command. So spatial Durbin model. Okay, you can see here, this model can capture the externality factor through dependent variable. Okay, as we can see here, it's quite consistent. Okay, the globalization has a spillover effect. The globalization index in our neighboring country, a change of globalization index in our neighboring country will affect our GDP in a positive manner with how many percent? Here, 4.881%, quite big. Okay, quite big. So, but still, it's consistent with the previous method, the previous command. It's still positive, but then different coefficient. We consider it as a what do we call this? What is spillover effect, because the coefficient is positive. Now, for the corruption index, negative. Okay, a change in corruption in our neighboring country will affect our GDP negatively. Okay, in a negative manner. So by how many percent? 0.1442%. So it is significant. So this is what it means. So it is consistent in term of the sign, in term of the sign, but then not consistent in term of the value of the coefficient. Okay, all right. So now, can we go to the issue? Okay. Now, so just now, we questioned about which one is the best model. So what we can do is the Hausman test. Again, as I told you, the problem that we are facing, we are really rely on the development in software, right? This one. So due to this, sometimes the command cannot the command cannot proceed with the Hausman test. Same thing. If you refer back to the technique in estimating random effect and fixed effect, we need to run random effect or fixed effect first, then we put the command for Hausman. The problem is that if let's say that command, we are facing this kind of problem, the Stata cannot read at all, so we cannot run the Hausman. So how? So alternatively, what we can do is you use AIC. We still believe on what Pasaran said. So the best model is when we have the smallest AIC, the smallest numbers of AIC. So if let's say if let's say the normally AIC is in a negative value, so meaning to say that the smallest value, the better the model. That is how we can decide which one is the most which one is the superior model. Okay, by indicating the value of AIC, which value of AIC is the greater. So still using the concept introduced by Pasaran in ARDL. So the bigger the AIC, the better the superior model. So I think, okay, right. This is my last slide. Okay. So as I told you, so I have demonstrated the spatial analysis based on geographical characteristic. So in a modern economy nowadays, geographical characteristic cross-border effect is not really the main factor to drive the externalities. Okay, it can be others like colonial factors, like Malaysia, right? We are a Commonwealth countries, so sometimes if we are in Commonwealth countries, we share the the law system, judiciary system. So maybe it will affect us in that way. Okay, and then sometimes we normally refer to Britain. So some issues, some economic issues, or some what do we call it, like geographical terms. Sometimes we need to refer to UK. So because of this colonial factor, like colonialism history can be done. So how can we do that? We put dummy, not dummy. You put zero, not a dummy. Okay, I'm sorry, not dummy. So you put zero stand for non apa, non-Commonwealth members, and then one stand for Commonwealth member. But bear in mind that is not a dummy. Just a matrix, not a dummy. Different. Okay, in terms of the language. So maybe we have an idea, a theory to say that if we are fluent in English, then it is more, we are ahead further to convince the foreigner that we are fluent in English. The communication would be much more easier. So the spillover can through that. Okay, and other thing, political ideology, communism nowadays, like Russia can have a good relationship with China, and they're the same country that share the same political ideology, then they are quite linear with that. That nature actually happen, can be part of that, can be part of the channel for externalities to drive its effect on a host or home country. So the last one is formal economic community like ASEAN. Okay, we can compare. We can come up with the evidence to say that if you are non-ASEAN, then the spillover effect is very less. The spillover effect is very small. So in ASEAN, we have a formal economic community, then we can share the prosper together. So nowadays we have BRICS, and up to now, the latest one we have Belt and Road Initiative members, and then last time we want to create another bloc, right, with US during the President Donald Trump last time, but then not that go further. So this is one of the thing that we can concern to instead. So what I'm trying to tell you, spatial effect is not just only cater the geographical factor due to the latest development in econometric software. We still can what do we call that? Identify the neighboring countries. It's not just only based on the distance geographical characteristic, but the neighboring country can be measured, can be determined, can be identified through other factors like colonial factor, language factor, political ideology factor, formal economic community, and so on. So that is my last slide. I think I have one question. Let me check. Murtaza, is there any way to know the direction of the spillover, meaning our country impacted? Basically, econometrically speaking, through dependent and independent. So if you want to try two ways, and then you need to restructure your model, but then somehow you need to bear in mind, you need to take much careful to ensure for whatever formation you make for the next for the next model, the other model, make sure it is in good fit, and then theoretically it makes sense. So it is not work as VECM or Granger causality. We need to check. We need to do it manually. But then for for each modification, you need to make sure your model is in good fit. Same rule if you do the mediation analysis, same thing. The theory must support your formation, and then your model is in good fit. Okay, that's all for me. I think I have another 7 minutes to open for any question.
Any question for Dr. Zul? Walaupun Dr. Zul dah jawab banyak soalan tadi, kalau nak tanya boleh je, silakan.
Pening. Yeah, spatial is quite advanced actually. Quite advanced in terms of the idea and then how it works in mathematics technique, statistically and mathematically is quite complex. So it's quite new, and then we need to have further development from software engineering side to help us to apply in order for us to be able to apply more spatial analysis. But then in a good way, in the bright side, actually it's good. The faster you learn, and then you are advanced than others in terms of the competition to publish. Once later the software become friendly user, then the competition is very tough for you to use this technique to publish. That's the game. But then somehow publication is not that much. It's not everything. No need to worry. You just, if let's say your satisfaction is more to that, then go ahead. So if let's say you want to have a good knowledge, want to discover a new thing for your own understanding in teaching, then it's one of the way. So how can I say? Yeah, spatial analysis is quite new and then quite complicated. And then you still wait for the next development in software engineering. Can we have another session? Inshallah. If there's any availability, I'm okay with that. But then we need 1.5 days to have an effective effective hands-on session, because it has a lot of steps that we need to go through in order for us to come up with a perfect and comprehensive spatial analysis estimation. 5 minutes, right? Another 5 minutes.
Any other question? Yeah, we will share the recording session. Dr. Ashraf will distribute to postgraduate students.
Any other question? Ada?
If there's no question, thank you very much to Dr. Zulhaswan, and thank you everyone for attending today's session.
Okay, I give the floor to you.
All right, thank you, Zul.
Right.
Okay, I will share the attendance, QR attendance, in case you haven't scanned the QR code. Thank you, everyone. Have a nice day. Okay, thank you everyone. Goodbye.